Hello, and welcome to 5-Minute Accounting Concepts. Today we're going to be talking about inventory cost formulas. So when a company sells a product, there are two entries. The first is to record the sale by debiting accounts receivable and crediting sales for the amount the item was sold for. The second entry is to expense the cost of the inventory item to the company now that it has been sold. We do this by debiting cost of goods sold, or COGS for short, and crediting inventory for the cost of the item. In order to determine the amount we need to expense in this second entry, we use a cost formula. Today we'll be covering 4 different cost formulas. These are specific identification, weighted average cost, first in first out, or FIFO for short, and last in first out, or LIFO for short. Specific identification is used when goods are unique and identifiable, for example with a luxury car. The cost of each item is tracked individually, so when we sell a specific car, we know the exact amount that we paid for it. So in that second entry, we simply debit cost of goods sold and credit inventory for this specific amount, because in this case it is known. On the other hand, when the cost for each physical item is not individually tracked, things get a little bit trickier. We have 3 options in this situation: weighted average cost, FIFO, or LIFO. We're going to use a little example to demonstrate these formulas, using an inventory item that would not be individually tracked. Let's go with canned tuna. The following are transactions of our fictional tuna business that buys cans from a packing company and sells them on to the end consumer. So on January 1st, our company purchased 100 cans of tuna at $10 per can. February 1st, they purchased 200 cans at $5 a can. Maybe they got some discounts for purchasing in bulk. On March 1st, they purchased 100 cans at $15 per can. And then finally on April 1st, they sold 150 cans. So this is the transaction for which we need to calculate cost of goods sold. First up is weighted average cost. When using this formula, we calculate an average cost per can as follows. So on January 1st, 100 cans are purchased at $10 per can. On February 1st, 200 cans are purchased at $5 per can. And then on March 1st, 100 cans were purchased at $15 per can. So we add these all up and then we divide them by the total number of cans purchased, which was 400. And that gives us a unit cost per can on average of $10 per can. We then apply this average number to the number of cans sold. So in this case, on April 1st, they sold 150 cans. So if we're costing that at $10 per can, that gives us a cost of goods sold of $1,500 total. Next up is first in, first out. As the name implies, we assume that the first cans to be sold are the first cans to be purchased. Since 150 units were sold, we assume that the first 100 of them were the 100 units purchased on January 1st, and the next 50 units are part of the 200 units purchased on February 1st. These are the first units to go into inventory. Therefore, under FIFO, they are assumed to be the first units to go out of inventory. The cost of goods sold recognized will be calculated as follows. So we have 100 units at $10 per can, plus the next 50, which are part of the 200 cans purchased at $5 per can, gives us a total COGS of $1,250. Lastly, LIFO is similar to FIFO, only we assume we are selling the most recently purchased units rather than the earliest purchased units. So out of the 150 units sold on April 1st, we assume that the first 100 are the latest 100 purchased March 1st. The remaining 50 are from the next most recent purchase, that being the 200 units acquired on February 1st. Cost of goods sold can be calculated as 100 cans times $15 per can plus 50 cans at $5 per can, which gives us a total cost of goods sold of $1,750. To conclude, the correct inventory cost formula is the one that best approximates the physical flow of goods. For example, a grocery store might use FIFO for their produce inventory, because in their business they try to sell the older vegetables first to avoid spoilage. Under IFRS and ASPE, specific identification, weighted average cost, and FIFO are all permitted. However, LIFO is not allowed. That being said, you are allowed to use LIFO under US GAAP. That's all I've got on inventory costing formulas. Thanks for watching. If you found this helpful, please like and subscribe for more videos. If you have any topics you'd like to see covered, feel free to leave your suggestions in the comments below.